Farmers who built their livelihoods around John Deere are now walking away in record numbers. This isn't just about one company. This is a crisis that threatens the entire $34 billion U.S. farming industry. In this video, we're breaking down why farmers are abandoning John Deere for the first time in history, how corporate greed is crushing small farms, and the global takeover could push American agriculture to the brink. Let's break it down. What's happening? In farming towns across the country, Deere's factories provided thousands of well-paying jobs, supporting entire communities. But today, many of those jobs no longer exist. Since the year 2015, John Deere has laid off more than 4,500 workers from its U.S. factories. In places like Waterloo, Iowa, and Molina, Illinois, entire communities were built around Deere's plants. When the company started cutting jobs, the economic impact was immediate. It's not just about losing a paycheck. When John Deere shuts down a plant or lays off workers, it creates a chain reaction. Local businesses suffer as restaurants, grocery stores, and small shops that relied on Deere workers lose customers. The housing market crashes because with fewer people employed, home values drop, and families are forced to relocate. Schools lose funding since public schools, funded by local taxes, struggle to stay afloat as families leave town. Other businesses hesitate to invest because, with job security gone, other industries avoid setting up shop in these areas. Why is Deere cutting jobs? The company blames declining equipment sales, but the truth is more complicated. Farmers, squeezed by low crop prices and rising costs, are postponing or canceling purchases of new tractors. This leads to lower sales for Deere, prompting factory slowdowns and layoffs. And the worst part? The layoffs aren't stopping. The most recent round of job cuts in 2024 left 200 workers without jobs in Iowa alone. And as farmers continue to struggle financially, Deere's downsizing may only get worse. For rural America, these job losses aren't just a temporary setback. They represent a fundamental shift in the farming economy. Towns that once thrived because of John Deere are now fighting for survival. And for many families, the damage is already done. But these layoffs were just the beginning. What came next sent farmers into full-blown revolt. Why farmers are abandoning John Deere? Imagine buying a brand new tractor, only to discover that you can't fix it yourself. Even a simple sensor replacement or software update requires a trip to an authorized John Deere service center, where farmers must pay thousands of dollars in fees. Why? Because John Deere has locked its equipment behind a digital wall. Modern tractors are now software dependent, meaning even basic repairs require access to Deere's proprietary diagnostic system. If a farmer tries to bypass this system or use an independent mechanic, they risk voiding their warranty or being locked out of their own tractor. For many farmers, this feels like extortion. They have spent hundreds of thousands of dollars on equipment, yet they don't fully own it. The backlash has been swift. Across the country, farmers have organized protests, lawsuits, and legislation aimed at forcing Deere to give them back the right to repair their own machinery. The right to repair movement has gained momentum, with states like Colorado passing laws that require Deere to loosen its repair restrictions. But for many farmers, it's too late. Fed up with John Deere's control tactics, they are actively looking for alternatives. Companies like Kubota, AGCO, and Case YH are gaining customers by offering equipment that farmers can repair themselves. Even more shocking, some farmers are importing tractors from overseas, turning to brands that offer repair freedom at a lower price. John Deere's refusal to listen to its customers has pushed thousands of once loyal farmers to abandon the brand. If this trend continues, it could spell long-term disaster for the company. But Deere's biggest challenge may not be its own customers. It may be coming from China. China's silent takeover. Chinese companies like YTO Group and Zoomlion have rapidly expanded their global market share, producing tractors and harvesters at half the cost of John Deere's models. While these machines may not be as advanced, they are affordable, easy to repair, and widely available. Three things that John Deere can no longer guarantee. And it's not just equipment. China's agriculture boom is crashing global crop prices, putting even more pressure on American farmers. Since the year 2022, the price of corn has dropped by 37%, soybeans have dropped by 24%, and wheat has dropped by 35%. For struggling U.S. farmers, these lower crop prices mean less profit, making it even harder to justify spending hundreds of thousands of dollars on John Deere tractors. Many are now considering Chinese-made alternatives as a way to cut costs and stay in business. This shift could spell long-term disaster for Deere. The company once dominated the global agricultural market, but if more farmers turn to cheaper, foreign-made alternatives, Deere's grip on the industry will weaken, potentially for good. But Deere's biggest challenge isn't just technology, it's the political war raging around its decisions. Trump versus John Deere. When John Deere announced it was shifting part of its manufacturing to Mexico, the backlash was immediate. Farmers, factory workers, and politicians across the country saw it as a betrayal, another American company choosing cheap foreign labor over U.S. jobs. But while public outrage was expected, the most explosive response came from Donald Trump himself. At a campaign rally, Trump made it clear, if John Deere follows through with its outsourcing plans, they will pay the price. His warning? A 200% tariff on Deere's Mexico-made equipment if they try to import it back into the U.S. This was not just a political statement, it was a serious economic threat. Trump had previously used tariffs to pressure companies into keeping jobs in the U.S., successfully preventing some automakers from outsourcing production. Now he was using the same strategy against John Deere. The logic behind the threat was simple. If Deere manufactures in Mexico, the tariffs would make their equipment too expensive to sell in the U.S., forcing the company to either abandon the move or take a financial hit. For farmers, this was a double-edged sword. While they wanted to keep manufacturing jobs in America, tariffs could also make farm equipment even more expensive, worsening an already dire financial situation. But Trump's threat also sent shockwaves through Wall Street. Investors feared that if tariffs were imposed, John Deere's supply chain would collapse, causing stock prices to plummet. The uncertainty was enough to send Deere's stock down over 1.5% in after-hours trading. While that may not seem like a massive drop in the high-stakes world of corporate finance, even small losses can shake investor confidence. With Trump leading in some early election polls, John Deere now faces a critical decision: reverse its outsourcing plans or risk financial and political fallout. If Trump wins the presidency again, will he force Deere to bring jobs back? And if Deere refuses, will farmers turn their backs on the brand for good? But as politicians argue, a much bigger crisis is brewing: the immigration crisis. While John Deere is struggling with technology, trade wars, and farmer boycotts, the biggest threat to the entire agricultural industry may come from immigration policy. For years, U.S. farms have depended on immigrant labor to keep production running. In fact, over 70% of all farm workers in the U.S. are immigrants, many of them undocumented. Now, with stricter immigration policies on the horizon, farmers are terrified that their already shrinking workforce will disappear entirely. If the U.S. deports or restricts farm workers, farms will struggle to harvest crops, leading to massive food shortages and price increases. The problem is already happening. In California, Florida, and Arizona, some farms have been forced to leave crops rotting in the fields because they couldn't find enough workers. Without immigrant labor, the cost of hiring American workers would skyrocket, making food production more expensive than ever. For John Deere, this crisis presents another challenge. If farmers cannot afford workers to operate equipment, why would they invest in new tractors and machinery? A shrinking workforce could mean even lower equipment sales, hitting Deere where it hurts the most, its bottom line. And if that wasn't enough, another force threatens to reshape farming on a global scale: the fall of American crop prices. American farmers are producing more food than ever before, but their profits are plummeting. Since the year 2022, the price of corn has fallen by over 30%, soybean prices have dropped by 24%, and wheat prices have sunk by 35%. For farmers, these numbers spell disaster. Lower crop prices mean lower revenue, and for many small and mid-sized farms already operating on razor-thin margins, this decline is pushing them to the brink of financial ruin. At the heart of this crisis is China's self-sufficiency strategy. For decades, experts predicted that China would become one of the largest importers of U.S. agricultural products. American farmers were assured that their crops, especially corn and soybeans, would always have a major buyer in China's growing economy. But instead of relying on U.S. imports, China has invested billions into its own agricultural sector. With government-backed initiatives, advanced farming techniques, and rapid expansion of domestic production, China has become far less dependent on foreign food supplies. As a result, demand for American crops has plummeted, leaving U.S. farmers struggling to find new buyers. This shift has thrown global markets into chaos. The United States once dominated global agricultural trade, but with China producing more of its own food, U.S. farmers are being squeezed out of the equation. Countries that once looked to America for food imports are now exploring cheaper alternatives, including crops from South America, Russia, and even China itself. Without strong international demand, U.S. farmers are being forced to sell their crops at lower prices, often barely covering the cost of production. And it is not just international markets causing problems. Domestically, American farmers are dealing with skyrocketing input costs. Fertilizer, fuel, and machinery prices have all surged, making it even harder for farmers to stay profitable. The result? A growing number of farms are shutting down, selling their land, or consolidating with larger agricultural corporations. The bottom line is clear. U.S. farmers are facing an economic storm they cannot control. If global demand for American crops continues to shrink and production costs continue to rise, the very foundation of the U.S. agricultural industry could be at risk. And it is not just prices. Extreme weather is making farming riskier than ever. Climate change and farming. American farmers have always battled the elements, but today's climate challenges are unlike anything seen before. In recent years, extreme weather events have become more frequent, more intense, and more destructive. Droughts in the Midwest have reached historic levels, leaving millions of acres of farmland dry and unproductive. Without adequate rainfall, crops wither, yields drop, and farmers lose entire harvests. The once reliable seasons that farmers depended on for generations are now unpredictable, making it harder than ever to plan and sustain a profitable farm. Wildfires, hurricanes, and flooding are also wreaking havoc on agriculture. In California, massive wildfires have destroyed vineyards and farmland, turning once fertile soil into scorched earth. Along the Gulf Coast, hurricanes have wiped out crops, flooded fields, and left farmers with nothing to harvest. In the South and Midwest, heavy rainfall has led to devastating floods, drowning fields before seeds even have a chance to grow. Beyond immediate destruction, climate change is shifting long-term farming conditions. Warmer temperatures are allowing pests and plant diseases to spread into regions that were once safe from infestation. Farmers are being forced to spend more on pesticides and disease prevention, further increasing their costs. Many farmers are trying to adapt by investing in drought-resistant crops, precision irrigation systems, and other climate-smart solutions. But these adaptations come with a cost, and not every farmer can afford them. The harsh reality is that climate change is making farming more expensive, more unpredictable, and more risky than ever before. If these trends continue, the future of American farming could be permanently altered. The U.S. has long been one of the world's top food producers, but as climate conditions become harsher, that dominance may fade. If farming becomes unviable in key agricultural regions, the entire industry could be forced to shrink, pushing even more farmers out of business. But while nature reshapes farming, corporate control is making things even worse. The corporate takeover. For over a century, family farms were the backbone of American agriculture. But in the last 4 decades, over 50% of small farms have disappeared. In their place, large agribusinesses and corporate farming giants have taken over, consolidating land and resources at an unprecedented rate. The reason for this shift is simple. Big agribusiness has the money, the technology, and the government support to survive economic downturns. While small farms struggle to keep up with falling crop prices and rising costs, large corporations can weather the storm. They have access to better financing, larger supply chains, and government subsidies that favor industrial-scale farming over independent farmers. These corporate farms also have the ability to invest in cutting-edge technology, automated harvesting, AI-driven crop monitoring, and high-efficiency irrigation systems that smaller farms simply cannot afford. This growing divide means that while large farms continue to expand and increase their market share, small farms are being squeezed out. The consequences of this consolidation are enormous, as fewer companies control more of the food supply. Prices, production methods, and even the types of crops grown are dictated by a handful of powerful agribusinesses. This reduces competition, limits consumer choice, and creates a system where independent farmers have little to no control over their own industry. If this trend continues, the future of farming will no longer be shaped by thousands of independent growers. It will be controlled by a few multinational corporations. But while corporations consolidate power, another crisis could reshape farming forever. The death of the American farmer. Can small farms survive? Rising costs, trade wars, corporate consolidation, and climate change are all putting intense pressure on small farmers. Many are being forced to sell their land, take on unsustainable debt, or leave the industry entirely. Government policies have done little to help. While large agribusinesses receive billions in subsidies, small and mid-sized farms often struggle to qualify for financial assistance. Without access to capital, many of these farms cannot afford new equipment, modern irrigation systems, or advanced fertilizers needed to stay competitive. Trade disputes have only made things worse. Tariffs, supply chain disruptions, and shifting international markets have cut farmers off from key buyers. Without strong export opportunities, many U.S. farmers are unable to sell their crops at profitable prices. The result? Family farms are disappearing at an alarming rate. Once a symbol of American independence, small farms are now being pushed out by economic and political forces beyond their control. So, what needs to happen? Can government policies be changed to protect small farmers? Could new technologies and farming cooperatives help level the playing field? Or is the decline of independent farming inevitable? And that leaves us with one last question. What comes next? Can John Deere survive this crisis? Its iconic green tractors and equipment have powered farms across the country, becoming an essential part of the food production system. But today, the company faces a crisis unlike any in its history. Declining sales, rising competition, and a loss of trust among its core customers have left John Deere in a precarious position. The big question now is whether it can recover, or if its best days are already behind it. The financial damage is significant. In recent years, Deere's profits have taken a hit as farmers delay equipment purchases due to falling crop prices and rising input costs. With interest rates making it more expensive to take out loans, fewer farmers can afford to buy new tractors or harvesters, leading to a slowdown in sales. At the same time, John Deere's reputation has suffered as it continues to push restrictive repair policies that frustrate customers. Farmers are tired of being locked into expensive maintenance plans that force them to rely on Deere's authorized technicians rather than fixing their equipment themselves. The backlash has been so severe that some farmers are abandoning Deere altogether, seeking alternative brands that offer more flexibility and affordability. Competitors are eager to capitalize on Deere's missteps. Companies like Kubota, AGCO, and Case YH have been gaining traction by offering more repair-friendly equipment at competitive prices. Additionally, smaller manufacturers, some from China and other foreign markets, are producing tractors that cost significantly less than Deere's models. For farmers struggling to stay afloat, these cheaper options are becoming more attractive. If John Deere does not address its pricing and repair policies soon, it could lose even more market share to these growing competitors. The path forward is uncertain. Deere could attempt to rebuild trust by rolling back its restrictive policies, offering more affordable financing options, or investing in technology that genuinely benefits farmers rather than just boosting corporate profits. Alternatively, the company could double down on its current strategy, continuing to prioritize automation and digital services, while tightening control over repairs and maintenance. The latter choice might bring short-term financial gains, but it risks alienating even more farmers in the long run. But the survival of farming isn't just about John Deere, it's about the entire industry. The new farming economy. As corporate agribusiness grows more powerful, small farmers are being forced to find new ways to survive. Many have realized that relying on traditional supply chains, where big corporations control pricing, distribution, and access to markets, leaves them vulnerable to economic downturns and policy changes. Instead of accepting these limitations, some farmers are taking matters into their own hands, embracing new business models that give them greater independence and financial stability. One of the most significant shifts in agriculture is the rise of direct-to-consumer sales. Rather than selling their crops to large processing companies or grocery chains, farmers are increasingly selling their products directly to consumers through farmers' markets, community-supported agriculture programs, and online platforms. This approach allows farmers to set their own prices, cut out the middlemen, and build direct relationships with customers who value fresh, locally grown food. The demand for farm-to-table products has surged in recent years, driven by consumers who want to know where their food comes from and how it is produced. Another key trend is the growth of farmer-owned cooperatives. In a cooperative model, multiple farmers pool their resources, share equipment, and collectively market their products. This strategy helps small farmers compete with large agribusinesses by increasing efficiency and reducing costs, Cooperatives can negotiate better prices for supplies, invest in shared infrastructure like cold storage and distribution networks, and gain access to larger markets that would be difficult to reach individually. Some of the most successful agricultural co-ops have been able to provide their members with the economic stability that corporate-controlled farming systems often fail to deliver. At the same time, some farmers are abandoning traditional supply chains entirely, turning to regenerative and sustainable farming practices that prioritize soil health, biodiversity, and long-term resilience. These methods often require fewer expensive inputs, making them more cost-effective over time. By focusing on regenerative agriculture, farmers can reduce their dependence on synthetic fertilizers and pesticides while improving the health of their land. This approach not only benefits the environment, but also appeals to a growing number of consumers who are willing to pay premium prices for food produced with sustainable practices. However, challenges remain. Direct-to-consumer sales require farmers to develop new business skills, such as marketing, logistics, and online sales management. Cooperatives demand strong leadership and collaboration among members, which can be difficult to maintain. And while regenerative farming has long-term benefits, it can take years to see financial returns, making it a risky transition for farmers already struggling to stay afloat. Despite these obstacles, the shift toward a more independent, localized farming economy represents a potential path forward for small and mid-sized farmers. The key question is whether these alternative models can grow quickly enough to provide a real alternative to the current corporate-dominated system. But while farmers innovate, one last factor could determine the fate of the industry. The final verdict: can farming be saved? The American farming industry is facing its greatest challenge in decades. Economic pressures, corporate control, global competition, and climate change are converging to create an uncertain future for farmers. But is farming doomed, or can it be saved? The answer depends on a combination of policy changes, technological innovation, and a shift in the way we think about food production. One of the most urgent issues is the need for policy reforms that support small farmers. Government programs that provide financial assistance, lower interest loans, and grants for sustainable farming practices could help level the playing field. Current subsidy structures often favor large agribusinesses, leaving independent farmers at a disadvantage. A shift in federal and state policies could make it easier for small farms to access the resources they need to compete and thrive. Trade agreements must also be restructured to ensure that American farmers have access to global markets. The loss of China as a major buyer for U.S. agricultural products has exposed how fragile international trade can be. Strengthening partnerships with other countries and diversifying export markets could help mitigate the risks associated with relying too heavily on any single buyer. Technology will also play a crucial role in shaping the future of farming. While automation and precision agriculture have the potential to increase efficiency and reduce costs, these innovations must be accessible to all farmers, not just large corporations. If only the biggest farms can afford advanced technology, the industry will continue to consolidate, pushing small farms out of business. Investment in affordable precision farming tools, regenerative agriculture techniques, and cooperative farming models could create a more sustainable and inclusive agricultural system. Finally, the workforce crisis must be addressed. If farm labor shortages continue to grow, farmers will struggle to produce enough food to meet demand. Policies that provide legal pathways for immigrant farm workers, along with initiatives that encourage younger generations to pursue careers in agriculture. Despite these challenges, there is still hope. Farming has always been an industry that adapts to change, and the resilience of farmers should not be underestimated. With the right support, innovation, and policy changes, the agricultural sector can not only survive but thrive. The key is ensuring that the benefits of technological and economic progress reach all farmers, not just the largest players. Will American farming recover, evolve, or collapse? The answer lies in the choices we make today. Can John Deere recover, or is this the beginning of the end? Will small farmers survive, or is corporate farming inevitable? Drop your thoughts in the comments. If you found this insightful, like and subscribe to our channel for more deep dives. Thanks for watching. See you in the next one.